What if the biggest barrier to building wealth isn't the economy or your job or even the opportunities available, but actually the way your own brain is wired? Welcome to the Deep Dive, where today we're unlocking the cognitive science behind wealth creation.
That's right. We're diving deep into how ambitious professionals, entrepreneurs, and investors, like yourself, can understand and leverage the hidden workings of your mind to make truly smarter financial decisions.
Yeah, consider this your personalized cognitive finance lab. We've sifted through some fascinating stuff, articles on mental models, the thinking tools the wealthy use,
Mm-hmm.
the often surprising traps of cognitive biases that can derail our financial plans,
Yeah, those are sneaky.
the cutting-edge field of neuroeconomics, which
Really?
looks at our brains on money, basically,
Yeah.
and insightful studies drawing direct links between, well, our mental abilities and our financial outcomes.
And our mission in this deep dive really is to pull out the most powerful, actionable insights from all this material. The kind of insights that can fundamentally rewire your financial thinking and give you a genuine, sustainable financial edge.
Okay, let's unpack this then.
Yeah.
Starting with the core,
Hmm.
what many people call the millionaire mindset.
Right. And an interesting aspect of this millionaire mindset is that it's much more than just thinking positively or saying affirmations. One of our sources points out that your level of wealth isn't simply a result of external factors.
Sure.
It's deeply intertwined with the fundamental way you conceptualize and approach money. It often requires a really significant shift in perspective.
Absolutely. The traditional path, the one many of us are taught, it revolves around trading time for money, earning a certain amount per hour.
The standard model.
But the mindset really prevalent among wealth builders focuses on owning or controlling assets that generate income, often using other people's time and effort. Think businesses, real estate, intellectual property, things that can make money even while you're not actively working.
It's that classic Warren Buffett quote, isn't it? If you don't find a way to make money while you sleep, you will work until you die. It's about building equity, building ownership, not just chasing a higher salary.
Exactly. And another source also touches on a point that might feel a bit uncomfortable. Often, the best time to start something financially significant is, well, before you feel completely prepared.
That raises a really important point for listeners to consider. Are you perhaps holding back from taking crucial financial steps, maybe launching that business idea, making that first investment because you feel you need, I don't know, more knowledge or more capital?
Yeah, that resonates.
The millionaire mindset kind of suggests that waiting for absolute certainty can actually be a form of procrastination, and taking calculated action, even when there's some uncertainty, is often the catalyst for progress.
Which aligns perfectly with why people listen to this deep dive, wanting to gain knowledge quickly but thoroughly. Understanding this foundational mindset shift is like step one for building wealth effectively.
Definitely.
Now, shifting gears slightly, another really powerful cognitive tool for financial decision-making comes from Jeff Bezos, highlighted in one of the articles, the mental model of minimizing future regret.
Ah, yes, the regret minimization framework. An interesting aspect of this model is how it compels you to, project yourself into the future.
Right.
And evaluate your current choices based on the potential regrets they might cause later on. Bezos famously used this when deciding to leave a stable job and actually a short-term bonus to pursue the long-term vision of Amazon.
Wow. So how might this apply to, your own financial life?
Yeah.
Think about those times you might be tempted by immediate pleasures, that impulse buy, that fancy upgrade, versus making choices that could yield significant long-term benefits like investing or saving diligently. One source paints this vivid picture. Imagine your 80-year-old self looking back and wondering why your younger years were just about making ends meet, rather than building lasting security. It's powerful.
It really is. This future regret minimization model encourages you to look beyond just today's needs and consider the financial legacy you're actually creating.
So it raises a crucial question for everyone listening. When you consider your current spending and saving habits, do you foresee any potential for significant regret down the line? Are your choices now aligned with the financial future you actually envision?
Heavy stuff, but important.
Definitely. Now, we often like to think we approach our finances with cool logic, right? But another article really shines a light on the multitude of cognitive biases that can systematically undermine our best intentions when it comes to managing money.
Oh, absolutely. These biases can manifest in so many ways, it's kind of scary. Well, take the feeling that it's too complicated to understand investing, perhaps, or the belief that I simply don't have enough money to even start. These are often mental shortcuts rooted in fear or maybe a lack of confidence rather than, objective financial realities.
Yeah.
Even the tendency to only invest in what feels familiar, regardless of the actual potential, or prematurely panicking when the market fluctuates, those are examples of how our limited knowledge or just ingrained anxieties can really limit our financial growth.
And what about relying on advisors?
Well, while seeking professional advice is often smart, the assumption that a financial advisor will always do a better job than I can sometimes be a way of sort of abdicating responsibility for your own financial literacy.
It's almost as if we erect these invisible mental barriers, these self-limiting beliefs that keep us stuck financially. The article really encourages you, the listener, to actively challenge these assumptions and embrace a new, more empowered perspective.
It even poses a thought-provoking question. What if you actually possess a greater aptitude for managing money than you currently believe?
That's interesting. And this is particularly relevant because these very biases can contribute significantly to that feeling of being overwhelmed by financial information. So, recognizing and actively dismantling these biases is a fundamental step towards taking control.
And if we connect this to the bigger picture, overcoming these inherent biases often requires a conscious effort to learn and adapt our thinking, which leads us neatly to our next point, actually.
Exactly. A fascinating PDF we looked at suggests that our financial strategies aren't fixed or purely the result of logical optimization. They're actually dynamic outcomes shaped by a continuous process of learning and adaptation over time.
Yeah, an interesting aspect here is the role of reinforcement processes. Our past financial experiences, both the good and the bad, tend to reinforce particular behaviors and strategies.
Makes sense.
So, for instance, if a certain type of spending provides immediate gratification, we're more likely to repeat it, even if it doesn't really align with our long-term financial goals.
Right.
And similarly, successful investments might increase our appetite for risk, while big financial losses could make us overly risk-averse in the future, perhaps missing out on opportunities.
And it gets even more granular, doesn't it? The research also highlights how individuals frequently employ different sets of rules or strategies in different areas of their financial lives.
Totally. The way we approach spending might be governed by a completely different psychological framework than how we save or invest.
So it really underscores the idea that there isn't a single monolithic money brain, but rather a collection of learned behaviors and mental models we've developed.
Which is particularly relevant for our listeners, given their varied technical expertise. Depending on your background and past experiences, certain approaches to managing different parts of your finances might just feel more intuitive or appealing.
So this raises an important question for you listening. Are you consciously aware of the different rules or mental frameworks you might be subconsciously applying to various aspects of your financial life? And crucially, are these rules actually serving your overarching long-term financial objectives?
Something to ponder.
Now let's delve into a concept we all engage in, often without realizing its profound impact: mental accounting. This idea is a key element in that Why Can I PDF, and also a cornerstone of the work of Sheffrin and Thaler in behavioral economics.
Right, mental accounting. What's interesting here is the insight that we don't treat all our money as like one single interchangeable pool. Instead, we tend to mentally categorize it into different accounts or pots, with each earmarked for a specific purpose or goal.
Think about it in your own life. You might have a designated vacation fund, right? Or a separate down payment savings, or even an informal emergency fund tucked away somewhere.
Absolutely.
Even though the money's ultimately all yours, you likely treat the funds in each of these mental accounts differently.
And the research elaborates on how individuals actively create these saving pots with specific labels and even use self-control tools like automatic transfers to effectively manage these distinct financial goals, whether it's for security, future growth, or some specific purpose.
So if we connect this to the bigger picture, understanding and consciously leveraging mental accounting can be a really powerful tool for creating financial structure and achieving your objectives.
Yeah, by intentionally setting up these mental categories and the systems to manage them, you can exert greater control over spending and ensure you're strategically allocating resources toward your various financial goals. This relates directly to that need for clear structure when processing complex info.
Okay, so we've explored the millionaire mindset, thinking long-term, overcoming biases, financial learning, mental accounting. But what about those who've gone even further? Let's turn our attention to billionaire thinking, drawing insights from the Billionaire Mindset podcast source.
Ah, yes. An interesting distinction highlighted there is the difference in primary motivation. While many millionaires might be largely focused on accumulating wealth for personal security, comfort,
Right.
billionaires often seem to operate with a driving force centered around impact over money.
We're talking about people like Tony Robbins wanting to feed 1 billion people, or Mark Lohr's vision of a utopian city, or Elon Musk trying to get us to Mars. For them, money becomes a tool, a resource, to facilitate these massive, often world-changing goals.
Exactly. And another key characteristic, according to the podcast, is this unwavering commitment to constant learning and self-improvement.
Like Bill Gates in his reading weeks.
Precisely. These individuals show a relentless curiosity, often studying history, foundational principles, trying to understand the dynamics of success. Grant Cardone even suggests burnout isn't from too much work, but from a lack of unexpected wins, implying this continuous drive for progress and knowledge.
Interesting take. And then there's thinking bigger using leverage. Billionaires typically don't just scale one business. They often manage multiple ventures simultaneously.
Effectively leveraging the skills and expertise of exceptional teams to execute on a grand scale. Their focus is often on tackling huge global problems, which just inherently requires a level of leverage far beyond what most of us usually consider.
The podcast also draws a crucial contrast in how millionaires and billionaires approach time and resources, optimizing for time.
Yeah, this is key. While a millionaire might instinctively focus on minimizing every little expense, billionaires often prioritize maximizing their time.
How so?
They tend to think in terms of decades, strategically reinvesting profits for massive long-term growth, even if it means sacrificing short-term profitability. Think Bezos with early Amazon again.
Right, playing the long game. And perhaps one of the most intriguing aspects is the contrarian approach to decision-making.
Billionaires are constantly evaluating risk versus reward, often trying to limit their potential downside while allowing for, virtually a limited upside.
Asymmetric bets.
Exactly. They take calculated risks, and when they spot an opportunity where the potential gain massively outweighs the potential loss, they're often willing to make concentrated bets, rather than sticking to the diversification strategies many millionaires favor.
This deeper look into billionaire thinking, it really should provide some significant aha moments for listeners. It illustrates a different level of ambition, a vastly different scale of thinking, and a fundamentally different relationship with both money and time.
Absolutely.
Now, building on this theme of strategic thinking, another source highlights a critical mindset shift often seen in billionaire founders: the conscious prioritization of thinking hard over simply working hard.
Yeah, an interesting insight here is the emphasis on actively creating space for deep strategic contemplation. Billionaire founders don't necessarily spend every waking moment in the daily grind.
Right. Many cultivate hobbies or activities like chess, hiking, creative pursuits that allow their brain's default mode network to kick in.
And it's during these periods when the conscious, problem-solving part of the mind takes a break that unexpected insights and innovative solutions often emerge. Complex problems can seem to resolve themselves as the subconscious works in the background.
That's a valuable reminder, especially if you sometimes feel overwhelmed by just constant activity. Intentionally scheduling time for reflection, for strategic thinking, can be far more productive in the long run than just being perpetually busy.
And if we connect this back to learning and adaptation, this thinking hard approach facilitates deeper processing and allows for more innovative problem solving and strategic planning.
Okay, now let's pivot slightly and address a fundamental aspect of wealth creation in any business or professional endeavor: the crucial role of selling and promotion. One YouTube channel we looked at really emphasizes the vital importance of this skill.
Right. And an interesting assertion here is that selling isn't just confined to formal sales transactions. It actually permeates almost every facet of our lives.
How do you mean?
Well, think about it. Convincing a colleague about your proposal, persuading your family on a vacation spot, these are all forms of selling and influence. Even we right now are essentially selling listeners on these ideas.
Yeah, true. It really highlights that even with a groundbreaking product or an exceptional service, if you're not willing or able to effectively communicate its value, your financial progress is likely to be limited.
So cultivating your ability to sell and promote effectively is absolutely essential for income generation, whether you're an entrepreneur or an ambitious professional trying to climb the ladder.
Which raises a key question for your own ambitions. Are you actively developing your selling and promotional skills, recognizing how pivotal they are?
And it's not just about generating income, it's equally crucial to manage that income effectively. That same channel underscores that wealthy individuals manage their money well, viewing it as a valuable tool that requires understanding and skillful mastery.
Exactly. They draw a contrast with those who struggle financially, who often show a general lack of financial education. Many people invest tons of time learning new tech, right? Yet they neglect to learn the fundamental principles of how money actually works: budgeting, saving, investing.
This point really resonates with someone actively seeking knowledge, like our listeners. Mastering the art of managing your finances is just as critical as earning the money in the first place. It's about being a responsible steward of your resources.
And if we connect this back to overcoming biases, a lack of financial literacy often feeds those self-limiting beliefs we talked about.
Yeah.
Investing time in financial knowledge empowers you to make informed decisions and break free from those fears.
Good point.
Now let's shift perspective again and consider the power of appreciation. Another YouTube source emphasizes the often overlooked importance of focusing on what you already have, essentially cultivating gratitude.
Yeah, an interesting aspect of this perspective is the idea that instead of constantly focusing on what's lacking, successful individuals actively recognize and leverage the resources and opportunities already available to them.
Like what kind of resources?
Well, it could be their health, their existing skills, their network, or even just readily accessible tools like a smartphone for continuous learning.
The channel highlights the transformative power of gratitude and actively identifying the tools you currently possess. It even frames success as a mix of strategy, consistency, and faith in your ability to achieve your goals.
This perspective can be really valuable for listeners who appreciate multiple viewpoints and might be seeking a more positive, empowering lens for their financial journey.
And it connects directly to shifting your mindset. By consciously focusing on abundance and the resources you have, rather than dwelling on scarcity, you can often spot pathways to wealth you might have previously missed.
Absolutely. Another crucial mindset shift discussed is the perspective on learning from mistakes, consciously reframing failure as invaluable lessons, not just negative outcomes.
What's powerful here is the emphasis on actively reframing setbacks. Society often conditions us to see failure as something to avoid at all costs.
Right, totally. But successful individuals understand that failure is intrinsic, often necessary, to learning and growth. Each misstep gives valuable insights, allowing for course correction and refining strategies.
This is such a vital perspective for anyone striving for significant achievement. Embracing failure as a learning opportunity empowers you to take more calculated risks, experiment more freely, and ultimately accelerate your progress.
And connecting back to adaptation, actively learning from mistakes is a key driver in continuously refining your financial strategies over time.
Now let's discuss a common pitfall that financially savvy individuals learn to consciously avoid: the sunk cost trap. A trading source explains this well.
Right, the sunk cost fallacy. What's crucial here is that wealthy individuals tend to make rational decisions based on future potential, not on past investments of time, money, or emotion. They have the discipline to cut losses on underperforming assets or ventures, regardless of how much they've already put in.
Which stands in stark contrast to those who struggle and often keep pouring resources into failing endeavors, desperately hoping to recover past losses. That emotional attachment clouds judgment and prevents them from seizing better opportunities.
So for listeners making investment decisions, maintaining objectivity and consciously avoiding this sunk cost fallacy is absolutely paramount for long-term success.
It relates directly back to overcoming those emotional biases that make us irrationally cling to losing propositions just because of what we've already invested.
Definitely. Another source underscores the significant influence of the power of association, consciously surrounding yourself with successful and positive people.
What's valuable here is recognizing that your network can profoundly shape your thinking, expose you to new opportunities, and significantly impact your financial trajectory.
Yeah, by intentionally connecting with individuals who've achieved financial success, you can gain invaluable insights, adopt new perspectives, and even get access to opportunities you might have otherwise missed.
This strongly resonates with the idea of actively seeking mentors and role models. Cultivating relationships with the right people can be a powerful catalyst for your own growth.
And it aligns with social psychology research showing the powerful influence of our social environment on our beliefs, behaviors, and outcomes.
Another key differentiator in mindset, according to one source, is how the wealthy versus those struggling financially tend to view problems.
What's insightful here is the fundamental difference. People facing financial difficulties often see problems as insurmountable obstacles, reasons to give up.
Whereas,
Conversely, those who achieve financial success tend to view problems as challenges to overcome, as opportunities for learning, growth, and ultimately profit. The example given of the real estate investor seeing roadblocks as puzzles to solve perfectly illustrates this proactive mindset.
that mindset shift is crucial for entrepreneurs and anyone with a problem-solving orientation. Actively reframing challenges as opportunities can unlock innovation and pave the way for success.
And it connects back to adaptation, viewing problems as opportunities encourages a resourceful, flexible approach, fostering resilience.
Finally, that same source emphasizes the critical importance of focusing on net worth rather than solely on working income.
Right. What's vital to grasp is the distinction. Working income is what you earn from your job or business. Net worth is the total value of your assets minus liabilities.
And wealthy individuals understand that true, lasting security comes from building a substantial net worth, accumulating assets that generate wealth over time, not just relying on a paycheck.
While a steady income is essential, the primary focus for long-term security needs to be on strategically acquiring and growing income-generating assets, real estate, investments, businesses. That long-term perspective is key.
This directly ties back to the equity over salary idea from the start. Building net worth is about owning those assets that generate income even when you're not actively working. Now, let's delve into some fascinating research connecting cognitive ability directly to financial well-being, drawing from that Why Kanaya PDF and another compelling study.
What's particularly striking is the finding that higher childhood cognitive ability does correlate with greater financial well-being in adulthood, including higher total savings.
And the research also observes the increasing prevalence of elite educational backgrounds, especially in tech and finance, among billionaires, suggesting a potential link between strong cognitive abilities and creating significant wealth.
However, the other study reveals a more nuanced picture, particularly with debt. It found an inverse U-shaped relationship,
Meaning,
meaning individuals with average cognitive ability might actually carry higher debt compared to those with both lower and very high cognitive abilities.
so it's not a simple straight line.
Exactly. It's an important nuance. It subtly addresses any assumptions you might make about a direct link between your cognitive abilities and financial outcomes. The relationship is complex, and many other factors play significant roles.
Okay, finally, let's explore the often underestimated influence of expectations on our financial decisions, based on that Science Direct article, When a Gain Becomes a Loss.
Right. What's intriguing here is the idea that our beliefs and projections about our future financial standing can serve as powerful reference points, significantly influencing our current choices and risk tolerance.
So something that's objectively a gain, like modest savings interest.
Can paradoxically be perceived as a loss if you anticipate your wealth will grow much faster elsewhere.
The article gives an example. Choosing between a low-risk savings account and a higher-risk investment. If you have high expectations for future wealth, that guaranteed but lower return might feel like a relative loss compared to your anticipated growth.
It can even influence how we see seemingly safe things like bonds. They might appear as a small sure loss compared to riskier assets if our future wealth expectations are very high. It's fascinating how our projections shape present behavior.
So this raises a crucial question for you listening. How are your own financial projections, your expectations about future wealth, influencing the decisions you're making today? Are you perhaps taking on more risk or viewing prudent options as less attractive based on where you envisioned your finances heading?
A lot to think about there.
So as we bring this deep dive to a close, wow, we've journeyed through a lot in the cognitive science behind wealth. We've examined mindset shifts, long-term perspective, challenging biases, learning and adaptation, mental accounting.
Billionaire thinking, strategic thought, selling, money management, gratitude, reframing failure, sunk costs, association, seeing opportunities.
Focusing on net worth, the complex role of cognitive ability, and the influence of expectations.
Yeah. And the most important takeaway really is that these aren't just abstract psychological theories. They are practical, actionable insights into your own mind that you can actively apply to make smarter, more informed, and ultimately more successful financial choices.
So, now that you've explored these cognitive dimensions of wealth creation, here's a final thought-provoking question for you to consider long after this deep dive ends. What is one belief you currently hold about money? about your own financial capabilities or about the path to wealth itself that you feel compelled to challenge today.
Yeah, take some time to really reflect on the points we've discussed. Consider their specific relevance to your financial journey.
Perhaps even revisit some of the sources. This deep dive, as insightful as it's been, is truly just the beginning of becoming more cognitively aware and financially empowered.